how economists are modeling the determination of prices and investment behavior in OTC market settings. Wow, this is dramatic.
Being recorded.
I am being recorded. I'll be careful what I say. Well, still, things could go wrong. Okay, so what I want to do is I'm going to take you through what I consider to be the sort of first cut model, which is about 10 years old now. And then we can discuss in practice how these first cut models are being elaborated to handle some of the issues we discussed this morning. So in this first cut situation, you can think of yourselves as market participants who don't have the benefit of a dealer. You're going to find each other directly by search. Chris is no longer standing up with a sign saying, I am a dealer, I will offer bid and offer quotes to anyone that comes to me. The theory has been extended to handle Chris as a broker-dealer, and Chris, when that theory is elaborated, Chris will know that if he offers bids and quotes that are too aggressive, meaning very wide bid-ask spreads, taking advantage of his monopoly position, then we all would have the outside option of searching among ourselves, and that would discipline Chris's quotes to some extent. He can't take full advantage of being a monopolist. And you can go from that to the endogenous formation of dealers. Why, who is it that sets themselves up as a dealer, and why? Well, there's an equilibrium of entry, and they know that there are enough of them to make a certain amount of money it's worthwhile investing in the capital to become a dealer. But otherwise, there's nothing special that distinguishes the dealer from anyone else. The next elaboration that one can do, which has also been done, is to go from a very large setting, which I'm going to be take for today's purposes to be infinite. We're going to assume that you are infinitely many market participants. One can go down to a finite number, and things get very complicated very quickly for reasons that you could imagine. Because I, as an individual investor, I'm not thinking of you as a massive sea of homogeneously distributed market participants, each acting independently. If I start to think about you as individuals, then I have a very high-dimensional stochastic process describing the environment in which I'm optimizing, and that makes my optimization problem much more difficult. So for today, we're going to do the first cut model. We will literally take you to be acting independently in a continuum, carefully, because as you know, there are some measure-theoretic treacheries there associated with the law of large numbers in a continuum. And in that way, by the law of large numbers, the distribution of your positions will be almost surely deterministic, and I'll be able to take advantage of that when I solve my own planning problem for when to trade and at what prices to trade, and how hard to search for counterparties. Okay, so that's where we're going in the next hour and a half. When I eventually meet one of you with whom to trade, we will have a negotiation. There's nothing like an exchange with a posted price and anyone can buy or sell what they like at that price. No, when I meet Chris, we will discuss the price and we will negotiate. We'll make each other offers. We'll reject and wait for the next counteroffer. And we'll eventually agree on a trade, and I'll describe that game. That particular game, one-on-one negotiation, was solved in a beautiful paper by Ariel Rubinstein in the 1980s. He's an Israeli economist. He wasn't applying it to the over-the-counter market. It was literally two market participants negotiating over the price to pay for an object. But we're going to take that and import it into this OTC market setting for the negotiation that takes place. The distinction between what we're doing and what Ariel did is that in Ariel's model, if you don't trade, then just go home. Whereas in our model, if I don't trade with Chris, if we break down in our negotiations, then I can go and search for somebody else. That's my backstop, that's my outside option. Chris knows that I have that outside option, and he bids accordingly. And I know that he has that outside option, and therefore I bid accordingly. It's common knowledge of this outside option to go search again in the same market. So this This, what I'm describing today is essentially based on a paper I did with Nikolai Gerlianu and Lasse Haya-Pedersen, as I said, about 10 years ago, a little more than 10 years ago now. And it's been elaborated a lot, but there's no point in discussing the elaborations if we haven't got the basic model down. Sanjeev.
There is a follow-up literature, Mario's work on decentralized trading. So I guess that you would talk about how this model, it probably differs in institutional.
Yeah. So in his model, it's essentially it's not like an OTC market setting because there's no single asset like a bond or a derivative contract that will keep paying out dividends indefinitely, which is retraded. So the setting that we're describing is truly a financial market setting, as opposed to simply a decentralized market. I do hope to leave enough time to talk about some of the network market, finite network market situations, which are, as I said, substantially more complicated. If you remember, there was this little colloquy this morning in which, if I didn't like Chris's order, I could go to, I forget, it was Sanjeev maybe, and if I didn't like his, I could go to Michael's, and if I ran out of dealers, I could go back to Chris, and there was this common knowledge that if I came back to Chris, he must have inferred that I had been to Sanjeev and Michael, and that would put him in a good position, and so on. That's very, very complicated, but it has been resolved to some extent. There's a nice paper by Haosheng Zhu that considers that, and I'm working on that problem right now with Haosheng and with a Stanford student. So these network OTC markets are really, really complicated. They require a rather different set of tools, but the same negotiation issues come up again. Okay, so here we go. I'm going to motivate this with starting with this massive sea of investors. So you can imagine yourselves to be buyers or sellers. So you in the room are located along this 0 to 1 line in the continuum. So think of yourselves as infinitely many. And Andrea, you're this dot right here. And so you're a buyer. You would like to buy the asset. And you're going to go off searching for someone. And in the simplest model, your search powers are not that good. You can't direct your search more towards sellers, which you would like to meet. You're just going to draw uniformly in this first pass. So you're going to draw a counterparty. You're going to go search for a counterparty, and if you find one, it'll be uniformly distributed on 0, 1 between buyers and sellers. And I wonder if this has a pointer. Yeah. So here's Andrea. She's going to cast a net and draw somebody on that vertical line segment. And if she catches a seller, somebody up in that top 40% of the population, she can make a trade. Okay? Now, we are literally going to have every pair in the continuum conducting that sort of search independently, one from the other. And you can actually construct a measure space, a product space of states of the world and investors on which that's possible and on which you can apply the law of large numbers. Okay, so let's see what happens. So the good event for Andrea, we'll put Andrea here. Andrea finds a buyer, and we'll call Andrea alpha for Andrea. And the buyers are located between 0 and 0.6 on the line, and we'll distribute them uniformly. That's with measure, say, d mu. Mu is the uniform measure on 0, 1. And since all of these events, there's Andrea, there's Chris, there's Michael, since they're all searching independently, we expect this to be almost surely have the same quantity of matches as the probability that Andrea finds a buyer. And if Andrea is searching uniformly, what's the probability that Andrea finds a buyer? I'm going to do a little testing here as we go, if you're listening.
Oh, she's looking for a seller.
She's looking for a seller, pardon me. Seller. Should test myself here.
Somebody was watching.
Good. So, what's the quantity of trades by which a buyer finds a seller? Well, first of all, what's the probability that Andrea finds a seller? 0.4. And now what's the total quantity of trades? There's 0.6 of these buyers. 0.6 uniform measure times 0.4. 0.24. So that's the quantity of matches by which a buyer finds a seller. And all of those matches occurred up in this rectangle up here. So trades occur in this rectangle. Trades also occur when a seller casts a net and finds a buyer, which is in this lower right rectangle. So the total quantity of trade matches is 0.48. And that's almost surely. Everybody with that calculation? That's an application of the law of large numbers for pairwise random matching. If you're interested, that's in a paper I did with Yanung Sun in the Annals of Applied Probability about, 7 or 8 years ago. So that's all legit. Now we're going to take it into continuous time. And instead of just happening that Andrea is searching once, she's going to search whenever the need arises, randomly in time. And we'll see what that means in a few moments. Any questions yet? So this is all very basic tool building, and then we'll get some equations going, and we'll find out when Andrea meets a seller, the price at which she will buy the asset from the seller. And then we'll basically have a model of how OTC markets work in the simplest possible case. Okay, good. Well, let's not do all that by symbols. I'll write it on the board. So let me write over here. Can everybody see this far away?
This model, like what the story that you were telling at the beginning, has the feature that search is just unguided.
Yeah, this is completely unguided search.
Unguided, yes.
And then you can do directed search. You can say, well, Andrea can more cheaply, she can allocate her search more efficiently if she tries to find sellers more than she tries to find buyers. So she may not be completely efficient. She may not be able to put 0 search on other buyers and 100% on other sellers, but she may be able to influence her searching towards the right people, and that can be handled as well. It's called directed search.
Also, the search could be guided to particular sellers, for example, if there is some asymmetries, but ex ante they are all symmetric.
Yeah, so in fact, I've been working on this problem for a while. You could have 5 classes of sellers, some of which are more appropriate than others, and she can direct her search to the more appropriate class. It would be pointless to try to find you in particular because that's a 0 probability event.
Sure.
Okay? Basic idea clear? So again, we're going to take this picture and turn it into a continuous time random matching model and then solve for the price at which Andrea buys the asset from whomever she meets who's willing to sell it. Okay? Now, here's my eraser. Is there an eraser?
Yes.
Yeah, here's one.
All the winds are there.
Can you really see all this all the way over to this board?
Yeah.
Okay. So we're going to have.
I can't read anything at the moment.
Amazing enough.
We're going to have 2 types of agents with respect to whether they already own the asset or not. There's going to be the owners and the non-owners. That's going to be very simple. We're not going to vary by quantity that you own, just you either own it or you don't own it. You're going to have a very basic model. And we're going to vary you also by whether you want to own it, that is, you have a high value for owning it, or whether you don't want it as much. You have a low value for owning it. And I'll distinguish those in a moment. So our 4 types of traders are high owners, meaning they have a high preference for owning the asset, and they do own it. They're very happy people. We have the high non-owners These are the people that would love to have the asset. They have a high preference for owning it, but they don't currently own it. They're kind of anxious to find it. That would be Andrea when she went looking for the asset. Then we have the low preference L owners. These are those with low interest in owning the asset, but happen to own it anyway, and they'd be happy to sell it if somebody found them or if they found somebody. And then we have the low non-owners, and they're content. They'd be willing to offer a price, but probably no one's going to trade with them because they can't offer a very high price for the asset. They don't own it already. They're probably not going to conduct trade. Okay, now let's see, think of these as the 4 states of a Markov chain. And by virtue of the fact of the law of large numbers, the fractions of each type in the population are going to be given deterministically by some vector mu t, which is mu high owners at t, mu high non-owners at t, mu low owners at t, and mu low non-owners at t. So there's a 4-dimensional measure value process, but there's only, because of the deterministic nature of matching, trust me, it's going to work, that there will be a deterministic mass vector of the 4 types in the population. And given that mass vector, we can all do our planning now based on which state we are. Because of this law of large numbers effect, we can each think of ourselves as having a 4-state Markov chain. We're all going to try to do the right thing based on where we are. Let's look at the transition intensities. I haven't told you yet what causes you to move your interest in owning the asset from high to low, and that's going to be simply a random mutation. So at a Poisson arrival intensity called KD for down, your preference type for owning the asset will move from high to low, and K up is the Poisson arrival intensity with which you move from low preference to high preference, and that's true regardless of your type. This is all by way of assumption. And again, this can all be elaborated. I'm giving you the baby model. Okay, so those are the random mutations, and those are useful because we want reasons for trade. We don't want trade to completely die out in 10 or 20 days once everybody's met somebody and got the asset if they want it. We want to jiggle people around, so they're either by virtue of regulation, changes in preference, changes in tax status, changes in risk aversion. Your daughter's getting married, you have to raise cash for a wedding, whatever it is. You need a reason to trade that's changing over time to keep things jiggling along. Otherwise, financial markets would die out in no time. We'd all settle down with whatever it is we wanted and stay there. Okay, so these mutations will keep people interested in changing their minds about whether they want to buy or sell the asset. Now comes the interesting part. Here, this guy here, this low owner, he doesn't really care about whether he owns the asset or not. He only gets a low, and I'll tell you exactly what the, I'll make it more concrete. I'm running out of space here. There's no more boards. Well, there is a hinge on these, but I better not do this one because I need this one. I'll just erase over here. I don't need this anymore.
The supply is constant.
Pardon me?
The supply of the
Okay, so that's good. The total supply is S, so that's one equation that will influence. And the total mass of the agents without loss of generality is 1. So ut transpose the vector of 1 is 1. Okay, so this is the total mass equation, and this is the total supply equation. Now there's still 2 degrees of freedom in this vector, and those are going to be determined by all of the transitions. Okay, if you own the asset and you are, let's draw a picture of your consumption path. this is time. And this is your consumption, cumulative consumption. So this is how much you've consumed so far during your life. And we'll start with Andrea, let's start with somebody who started by owning the asset but didn't really want to. So this is somebody that started in the low owner. This is an initially low owner position. A low owner started at time 0, and a low owner doesn't accumulate very much value for owning the asset. They only accumulate 1 minus delta per unit of time for owning the asset, where delta is some not frictional, but some preference parameter that determines the fact that this owner is not particularly interested in owning the asset. Whoops. Then, at some stopping time, t1, luckily enough, along comes Andrea and says, oh, you own the asset and you probably don't want to own it that much. I will offer you some money for it because I, says Andrea, get more than 1 minus delta for owning this asset. I get, yeah?
I say I don't, well, I negotiate with it, right?
You're going to negotiate, yeah. We haven't discussed the price yet, but you're confident that when you meet Chris, that you will find a price, and I'll explain why, at which you will agree to buy the asset from Chris, and that's going to be the Nash equilibrium, the unique subgame perfect Nash equilibrium of the game that you will play and that we'll see coming up in your negotiation. So at time t1, you bump into Chris. He's this guy that is running along, not getting very much cumulative utility from owning this asset, quite happy to sell it at the right price. And the price will turn out to be, this is Chris's path here, this is Chris. The price will be some amount P. And to make things simple, we'll assume that Chris immediately consumes this lump of consumption associated with the price P. So his cumulative consumption path jumps up by the amount P, the price of the asset, because he's going to gulp it down in one gulp. And now, Chris doesn't own the asset anymore, so he's not accumulating any consumption from owning the asset. Okay? You with me so far? Any questions about Chris's consumption path yet? Okay? Then, at some stopping time t2, Chris, who's now a low non-owner, has a shock to his preferences and becomes a high non-owner. That happens right here. What about Chris's consumption path? Just going to continue going flat. Chris is anxious to buy the asset, but there's no exchange. He can't just go in and say, I'm buying. He has to go find somebody. So he starts looking. He's like Andrea was a little while ago, and he goes looking for somebody. And at another stopping time, say T3, Chris finds Eric, who happens to own the asset and not be that interested in owning it. Chris pays the going price, which is P, which could depend on time in principle. We're going to solve for the steady state later. And Chris gives up P, immediately degulps the amount P, and now he starts collecting some serious amount of consumption per unit of time. One unit of consumption per unit of time, because he is now a high preference guy who owns the asset, and he'll continue until at some time t4 he gets another preference shock and he starts enjoying the asset much less than he had, and life continues as when he originally started. Yeah, Eric?
What if he suffers from being HM that he doesn't have the asset at once and the slope decreases?
Well, that could happen. You mean that's what happened right here. He got a preference shock.
No, from at stopping time T2.
Yes?
The slope could decrease.
Well, it's already 0. Either you own the asset or you don't. If you own the asset, yeah, he doesn't own it here, so he's not getting any utility from owning the asset.
But he could get negative utility from not having it.
No, that's psychic, but we don't charge psychic costs here. That's anxiety cost.
I'm supposed to be risk neutral then?
Yes, you're risk neutral.
Yeah, right.
Yeah.
So just I care about expectations, not.
What would change is the potential slope if you were to own the good, but it doesn't own the goods. Right?
Yeah. So that's the typical sample path of the life of Chris. We'll write it up, Chris. Hopefully your real life is more interesting than that. Okay, so we need to complete this Markov chain diagram, transition diagram. What we really need to do is, let's draw in the arrow for the Poisson arrival intensity with which Chris moves from being a low owner to being a low non-owner. Well, I haven't told you some parameters. I haven't told you the parameter describing the Poisson arrival intensity by which you actually find a counterparty once you're searching. Once you are a low owner, you're going to start searching, and counterparties will start searching for you. Remember, both of these rectangles are operative. Okay, and we'll assume that your Poisson arrival intensity for finding someone is lambda over 2. And there's a symmetric, as in that diagram, Poisson arrival intensity of someone finding you of intensity lambda over 2 for a total meeting intensity of lambda.
So do I have any control variables in this story?
Not in the baby version, but I can show you the version in which you can dial up your search intensity by making an effort at a cost.
Yeah.
And you get some really interesting results that way, by the way. But for now, we'll just assume that you're searching or you're not, and when you're searching at full power.
Okay, so I could switch off search completely. So I have a control in that sense.
Yeah, but it would be pointless. It'd be pointless to, I mean, there's no cost to you in this model for searching, so it wouldn't matter if you had it turned on all the time.
Okay.
So given that you're finding someone with intensity lambda over 2, and someone is finding you with intensity lambda over 2, the total intensity with which you meet somebody is lambda. However, not anyone you meet will conduct a trade with you, right? Who are the types of agents? Which are the types of agents that Chris could meet and successfully negotiate a trade? This is the most interesting part of the basic model. He is a low owner. What kind of investor does he need to meet? Well,
So I want to get a high or a low non-owner.
a high non-owner would be perfect,
Yeah.
because that sort of person would say, oh, yeah, I'll sell it for a price because I don't want it as much as you do. Another owner, well, they're in this model, they'd be indifferent anyway. It's linear preferences. And we're going to cap their quantity, just to make it simple, at 1 unit anyway. So the only type that Chris could meet that would make a trade are the high non-owners. How many are there of them? Or should I say more carefully, what is the mass of high non-owners? Well, it's already in the diagram.
Why not a low non-owner? I mean, that person might be prepared to take it off me, thinking that they could sell it for a better price later.
Yeah, we're not going to allow shorting because otherwise the model gets too complicated. So you're either going to go, you have linear preferences, you're going to go to the max positive or the max below, which is going to be 0. No shorting. Keep it simple. Okay, so this is the intensity with which you meet somebody, and you're going to have a thinning probability. The fraction of the population that's a suitable counterparty is the same as the probability that you meet a suitable counterparty, and that's the population of high non-owners at time t. Okay, if everybody gets that step, we're getting close to solving this model. And then similarly, the high non-owners will make a transition to being high owners with an intensity lambda, which is probability of somebody, times the probability that the somebody they meet is of the right type, which is a low owner. So that's our Markov chain. Now, I'm going to show you some solutions for it, but first we have to work out the pricing, and that's going to be occupying the next minutes. That's the most interesting part, because the who exchanges what with whom when is at this point, as Chris pointed out, purely mechanical. We haven't really given them the control power to influence the speed or volume of trade or anything like that. That can be done though. Sanjeev?
My understanding is that you're assuming that people know all these things.
When they meet
know
each
the
other.
type.
When they meet each other, in this model it won't really matter because there's only one type that would be willing to conduct a trade at which Chris would be willing to pay the price. But in a more complicated model, you would want to have people with badges on their shirts saying, I am preference type 13, to make the model easier to solve. If they have on their shirt, I am ambiguous type, then you get into bargaining with incomplete information. And you can do that, but it's really messy. Okay? So we're going to start working on the price at which Chris will buy the asset or sell the asset, in this case, in a moment.
This transition would be like this, no matter what the price determination is.
Yeah, that makes this model easier to solve, is that you know in advance the Markov chains before you even have to worry about the price, because we've hardwired in the fact that trade will occur. Of course, we have to prove that there is an Nash equilibrium in which trade does occur, and it will occur.
All these, this dynamics can be solved independently.
Independently. That's why this is the easy model. But there are more complicated models in which there's a simultaneity issue. Matt?
I was wondering whether you need an assumption on the relative size of lambda to the KD and the KU. The thing I'm worrying about is maybe it's best for me to keep holding on to the good even if I'm the low type, anticipating
Right. So we're actually going to prove that that's not going to be the case.
the bargaining price gets very
That the price, I mean, as you would guess, like in Rubinstein's model, you know, the off the equilibrium path stuff doesn't happen. That you will find a price at which you're willing to trade immediately. So that's a good question. You could hold out for a better price, and you won't choose to do that in equilibrium.
So there's efficiency.
Subject to the search frictions, there's full efficiency. That is, whenever the right trades should occur, they do occur. Of course, you know, a regulator who could influence the meeting times, the meeting intensities, the lambdas, by speeding them up, you know, or in the case that we discussed this morning, forcing dealers to offer quotes from multiple dealers rather than just one, so you get the best of n rather than the best of one price. That would be helpful. But here, it's one at a time. Everybody is a dealer, effectively. Okay, so there's the equations. Well, maybe I should do one of these equations before we get carried away. Again, a skill testing question. I'm going to give you the law of motion. I'll pick.
So, Darrell,
Yep.
following up on that, maybe this is premature,
Sure.
but supposing, you know, supposing you were to allow people to choose the search intensity, are these things complementary, or
Are they?
are they complementary in the sense that, you know, if you search
Yeah, okay, so that's a good question. So what I've done is solve this model in which the total meeting intensity, lambda, between types, let's say alpha and beta, is a function of the effort that the alpha type puts out multiplied by the effort that the beta type puts out, where f is a monotone increasing function, so you get complementarity. So that means the harder I search, the more that Chris wants to search for me, because we get complementary effects here. So this is the, in fact, this is the one where you can, that I know how to solve explicitly. But we're not going to do that today. We're just going to take the media intensities to be fixed. Okay, so what I want to do now is to describe the law of motion of this measure-valued process, again using a law of large numbers. So D, let's do Chris's type, low owner at t dt. So I'm going to describe the rate at which the quantity of Chris's type is changing. Well, I'll give you the first term. First of all, with intensity Ku, Chris is going to change his type from being low to high, and he's going to leave this population of low owners. So there's a minus intensity Ku with which Chris leaves the population, but Chris is not the only guy among this group. So what's the total mass rate of departure associated with mutation? This is the intensity for one individual. Law of large numbers, mu LO of t. So there's a linear term associated with out-migration coming from mutation. Now, there's going to be an incoming migration term. These are the types that are moving down in preference from being high preference. But we're not interested in all high preference types, only the ones that are going to move into the population of low owners. So what's the mass of those guys? Mu H O. Okay, we still have one more term to go associated with trade, but these first two terms are just random mutation. And this is all going to be almost surely, of course. Any questions so far? Okay, now we need to describe the rate of departures from low owner types. So this is going to be a minus sign. Chris is going to meet somebody with whom he trades and therefore becomes a different type with this intensity. That's the intensity with which Chris departs through trade. But Chris is not the only guy. So we're going to multiply that by mu LO. So this is a linear quadratic ODE. As far as I know, in the general case, it doesn't have a closed form solution. But the steady state case, it's a quadratic equation, essentially a Riccati equation. And not surprisingly, from any initial point, provided lambda is strictly positive, you'll converge to the steady state. So there is a steady state for this, but it's also interesting to look at the non-steady state case when we shock the market, and I'm going to give you some shocks to the market later, and then look at how prices evolve after a market shock, like the one that we saw in 2008, except this is a slightly more simple model than that.
For things like this, you can typically get multiple steady states.
Yeah, but not this one.
Not this one.
Yeah. There's a proof in the back of our paper that this is the only one. Yeah. Okay, so now we can zoom a little faster and start talking about pricing. Because now Chris can solve this equation. He now knows, for dynamic programming purposes, that he's got an optimization model effectively at what price he should trade when he trades. And if I write down the process, this is going to be maximizing his expected present value at a discount rate R, and that means that e to the minus RT times his value plus the integral from 0 to t of e to the minus rs discounted consumption is a martingale. That's just that would be the Hamilton-Jacobi-Bellman equation if there were much optimization going on. There is actually a decision by Chris to whether or not to trade at the offered price. We're going to get to that. But we're going to use this martingale condition to deduce the prices. Here's our mass equations for the 4 types. That gives us, again, as Fernando mentioned, we can solve this independently of the price, assuming the trade will occur, and then later we have to confirm that trade will occur. Here are the martingale conditions on the value functions of each type. Let's just check one of these. Take the top one, for example. The drift term in that martingale is r times the value function, and here we're putting in the type. So VLO is the indirect utility for continuing as a low owner type. That was Chris's type. So this is the discount factor term. Here is the rate of departure from being a low type to high type, and when that happens, the change in value is VHO minus VLO. I think you've probably all seen these kinds of martingale types of equations. Then there's an intensity lambda times mu HN with which Chris meets a high non-owner. When that happens, he immediately consumes P, the price for the asset, but he stops being a low owner and assumes the position of being a low non-owner. And as long as he's a low owner, he's getting utility at the rate 1 minus delta for owning the asset. So I'm guessing at least half the room has done stochastic processes and will recognize this as a kind of degenerate HJB equation, where the only real optimization is put in an indicator for whether you take this trade or not when it's offered. And it will be offered, and you will take it at the right price P, which we're going to solve later. That's all coming. For a low non-owner, it's much simpler. They have this discount rate effect, and then they have this transition intensity Ku of switching the values of being a low non-owner to being a high non-owner. And similarly for the other 2 types. So if you're keeping track of equations, there are unknown values for each type. There are 4 types, so there's 4 unknown V's. But there are 5 unknowns in this equation. One of them is P. So we have 4 equations and 5 unknowns. All of the mu's are known from solving the mass equations, as Fernando mentioned. So what we need is an equation for P to complete this. And that's where we get into Ariel Rubinstein's brilliant 1984, I think, paper, he discerned how to set up a bargaining protocol to solve for the price at which Chris and Andrea will exchange the asset when they meet each other, each knowing that their outside option is to go search again in this mass population for another counterparty with the consequent delays, et cetera, et cetera. And in equilibrium, as Rubinstein showed, they will immediately agree to trade at a price which is effectively reflecting their outside option bargaining power. So let's go through this briefly.
Sorry, in the original Rubinstein's paper, there is no outside option.
There is an outside option, it's 0, or they get...
Well, which is just not agreeing ever.
Yeah, not agreeing ever.
Because, I mean, where there is explicitly in the model an outside option, because there is also a population environment where bargaining takes place, is in the subsequent Rubinstein-Bolinsky.
Yes, that's true.
No, is it closer formally to what you're doing?
You could. We're actually going to use the Rubinstein game itself, and we're not going to use the Rubinstein-Wolinski application. That's for a different application. He doesn't have a long-lived asset. They do have a decentralized market, but it's a one-shot game. There's no long-lived asset.
Mm-hmm.
So this is different. We're trying to value this asset here. So again, we need an equation for P. Here is the way that the equation is solved. First of all, let's consider the reservation value for, let's take Chris first. This is Chris's current utility. If he sells the asset, he will become a low non-owner type. This is his loss of indirect utility associated with sale. His gain is the price. So he would never be willing to sell for less than this price. Whereas Andrea, she wants to achieve this high value of owning the asset. She currently only has this low non-owner value. This is the most that she would pay. So the price at which they do trade will be somewhere between the two. And for sake of naming it, let's call the point in between, that is the fraction of Chris's gain from this net gain from trade, call it Q. Call it bargaining power. It's going to be determined endogenously in a moment. Okay, so this bargaining power, once we know that, we're done. Let me repeat. If we knew where in between the two reservation values the price is determined, then we have 5 equations and 5 unknowns. They're linear. The model is solved. Okay, again, these are the 4 equations and 5 unknowns. Once we know Q, we have one more linear equation. That's 5 and 5, and we're done. We have to find out what Q is, and this is where we're going to use the Rubinstein theory. Okay, so here it comes. Well, I'm going to skip Nash in the interest of time. I'm going to go directly to, there is a cooperative bargaining approach due to John Nash that won a Nobel Prize. Kind of interesting, but I don't think we'll do it today, unless you really want to see it. We're going to go directly to the Rubinstein method. This is the...
Could you use the Nash solution at this point?
You could. It gives you an equivalent. I'll do it briefly. So...
Don't let me deflect you, but when I think of bargaining, I think of the Nash bargaining.
Okay, so it's a beautiful theory. Let's spend a couple of minutes on it. So here's what Nash did in 1950, well before Rubinstein. He said, well, you know, this is a complicated situation. Let's just lay down a few axioms that we believe should apply to their bargaining. So when Andrea and Chris meet, effectively, they have the following primitives. They have a compact set of feasible utilities they could achieve by bargaining. So it's a subset of R2. If they break down, in Nash's program, they have fixed outside option values called D1 and D2 for the 2 respective bargainers. Okay, rather than in our game where the outside option values are endogenous. We're going to assume there's a non-degeneracy condition, meaning that there's some bargain they could in principle achieve that would be better than their outside options. The set of all of these parameters is called a bargaining problem, and we'll let script B denote the set of bargaining problems. And Nash applied axioms to a bargaining solution, which is a function that maps bargaining problems to the respective utilities that Andrea and Chris will achieve. Okay, so here come the axioms that Nash proposed. One is Pareto efficiency. They won't leave money on the table in the sense that whatever they do, there can't be something that's strictly better for both of them. Now that's a pretty strong axiom if you ask me. It can be replaced with weaker axioms, and people have done that. But anyway, that's the strongest one, which is that there will be no inefficiency in the Pareto sense. Second one is symmetry. If you flip their names and flip everything else, they'll just get the flipped utilities. So that's trivial. Just means that the names don't matter. What matter are the primitive information about them. This one says if you make an affine transformation of their utilities, which is irrelevant from the viewpoint of preferences, then they won't change their bargaining approach. They'll just get an affine transformation of their original, the same affine transformation of their original utilities. And then the final one, which is kind of interesting and a slightly strong assumption, is that if they've decided on a particular solution, and then you say, as a central planner, look, I'm going to take away some of these other things that you didn't choose. Now, do you want to change your mind? They should say no. We optimized with the bigger set of possibilities. If you take away some stuff that we didn't want to choose anyway, we're not going to choose it. So if you have a bargaining solution F that satisfies all 4 axioms, then we know exactly how you will solve your problem. You will find the unique utilities that maximize the product of your gains from trade relative to your outside options. That's the Nash solution. Now we're going to do the Rubinstein one, which turns out to be equivalent. That was actually not shown by Rubinstein. It was shown in a later paper by Binmore, Rubinstein, and Walensky. So Rubinstein did this in '82, and then the three of them came along later and said, the solution of Rubinstein's game is the same as the Nash solution. Okay, so here's Rubinstein's game. Chris is the seller, Andrea is the buyer. It doesn't really matter in the end, but we'll let Andrea move first. She's going to propose a price to Chris. And Chris has two options in this Nash game. One is to accept, in which case they agree to trade at that price. Chris's other option is to reject. If Chris rejects, we're going to spin a wheel, and with some given probability eta, which is going to be a number that we'll choose to be quite small later on, but for now just take it as a given parameter of the model. With a given parameter eta, a spin of the wheel will cause a breakdown. They won't be able to trade with each other. And they're going to go search for other counterparties. Okay? They lost their opportunity to trade. You might say, gosh, that shouldn't happen. The answer is, it won't happen in equilibrium. In equilibrium, this is exactly what's going to happen. Chris is going to accept. But we need to know the consequences of Chris rejecting in order to solve the problem. And the consequence is that nature will spin a wheel, and with some probability eta, there'll be a breakdown, and they'll have to give up the opportunity to trade. With the complementary probability 1 minus eta, it'll be Chris's turn to propose a price to Andrea.
In the Nash solution, you said that the first axiom is not crucial.
I know, I said it is crucial and it is very strong. It's a strong axiom to assume that they achieve full efficiency.
So is there a way to enforce that in a decentralized way?
Right here. This is what Rubinstein did. So the solution of this game, in the limit as eta gets small, will be equivalent to the Nash solution.
You cannot solve this model for eta large, for example, eta 1.
You can solve it explicitly for eta sufficiently small, but it won't coincide with the Nash bargaining solution except as a limit when eta goes to 0.
Okay. So in what sense does when eta go to 0 this converge?
It converges to the Nash bargaining solution.
In what sense does it converge?
Pointwise.
Random. Okay.
The first offer will be accepted, and that offer will be the one that maximizes the product of the two gains from trade. And I'm going to give you the solution in a moment anyway.
One could argue that really this limit exercise that you're doing is perhaps not the most interesting one in the following sense. You are basically saying that the outside environment
Yes.
is basically of second order importance. Okay, that most of the action is purely bilateral.
True, except for one thing. The outside environment determines these breakdown values. And so the breakdown value for Andrea may be much worse than the breakdown value for Chris. And that may influence the gain from trade to Chris's favor.
Yeah, but this is in the Nash format. But if you just forget about Nash...
but the same thing. We're going to get exactly the same solution in this game. That is, their outside options to go search could be terrible if search intensities are low. If these lambdas are very low numbers, then they have to sit idly by for a long time wishing that they had sold the asset but were unable to. That's very costly. And that will have a big influence on the price at which they trade.
But this is if the lambda is endogenous, which the lambda is playing a role similar to the eta. No?
Lambda is the only role in this game that lambda actually it plays two roles. One is the indirect utility gain from moving from one type to another, that is these V's. And it also plays a role in terms of the outside option values, which are go search in a market where search matching is not very efficient. So it plays a pretty significant role in both places. Okay, does everybody have the idea? This game goes on ad infinitum, and because eta is strictly positive, it will complete with probability 1. That is, we're going to take these nature spins of the wheel here are going to be IID whenever they happen with probability eta. Eta is a strictly positive number. This game will complete in finite time almost surely. There will be an outcome. The equilibrium, however, given the threat of all this stuff down here, is that Chris will immediately agree to Andrea's offer. And you might say, well, Andrea has an advantage here in being the first proposer. It's true. However, as eta gets sufficiently small, it doesn't matter. In the limit, the price that Andrea offers to Chris is the same as the price at which Chris would offer to Andrea. It's when eta is big that Andrea has a big threat. Because if eta is a big number, Chris is thinking to himself, oh my gosh, if I say no, she's made a very aggressive proposed price. If I say no and eta is big, I could lose a big opportunity to trade. So Chris is at a big disadvantage when eta is big. But when eta goes to 0, neither is at much of a disadvantage to each other. The prices that they would offer converge to the Nash price. That's a theorem. And here is the application of the Binmore-Rubenstein-Walensky result to our setting, which is here is the gain from trade of Chris, here is the gain from trade of Andrea. When you maximize that with respect to P, which is what the Nash solution does, you get this solution for P, which is the average of the two reservation values. So they have equal bargaining power in this setting. Okay, so that's the application of Binmore-Rubenstein-Walensky to our over-the-counter market. Now we have an equation for P explicitly in terms of the V's. That's 5 equations and 5 unknowns. Plug it all in, we can solve the model. I'm not going to go through the details. I'm going to show you pictures instead. Okay, so here's a real-world application. I'll also show you a numerical solution from the model, but this is designed to warm you up with some actual data. So this is secondary equity offerings data. We're switching gears in case you hadn't noticed from abstract nonsense to real markets. So this is based on more than 4,000 different equity offerings by corporations. A secondary offering means you're already publicly traded. It's not an initial offering, and you're going to issue new shares to the public. Now when that's done, it's usually a fairly lumpy sale, right? Because a company needs to raise capital. It's not going to raise $100 worth. It's going to raise 100 million or a billion or 10 billion worth. And that's going to be a lot of new shares for the market to absorb. And you might say, well, you know, markets trade frequently. It shouldn't be that big of a deal. But the data say otherwise. The data say that the underwriters have to lay off block trades of equities in the over-the-counter market, and there's a significant price impact. Here is the average price path. This is the offering price here, this bar, relative to 100 being the secondary offering, the secondary market price on the offering day. So this is the secondary market. This is the primary market at which the underwriter took shares. So coming into the offering date, the prices dropped, and then they recovered gradually over time as those that bought it on the offering eventually found someone with whom they could trade. I'm going to show you another one from...
So prior to O, you couldn't actually trade these things?
No, you could. Because it's a secondary offering, the market was open all the way through here in the secondary market. But then this company said, I want to sell, you know, $1 billion worth of shares. You cannot get the underwriter to pay the secondary market price. They'll say, well, I'll take those at a discount of 2%. And anyone that does take it in the secondary market knows that there's a lot of shares suddenly available in the market on that single day. And so they're only willing to absorb them at a low price, hoping that they can find someone later who's willing to take them off their hands at a higher price. This would not happen in a market in which there's a continuous auction among all buyers and all sellers. you need some sort of friction. It doesn't have to be over-the-counter markets friction. It could be an inattention friction where people are not paying attention.
Sorry, I'm not sure I understand what the solid line.
Okay, so you call JP Morgan because you're going to issue shares to fund your skateboard factory. And JP Morgan says, well, how many shares do you want to issue? And you say, well, I'd like to issue $1 billion worth of shares. JP Morgan says, woof, that's a lot of shares, and you want us to find buyers for you, right? And Fernando says, yeah, we want to find buyers, of course. So JP Morgan says, well, look, that's a lot of shares on one day. Not every buyer in the universe is available on that day. We're going to have to go find some, and it'll take time. In the meantime, something happens to your skateboard company, we're going to lose money. So we're only going to take these shares if you sell them at a really cheap price relative to what they have been selling for in the secondary market.
Oh, okay, so this is the release of the plan.
And you say, wow, that's a big cost, but I'll do it anyway because I need the $1 billion. Meanwhile, the secondary market has heard, there's been an announcement, this dotted line here is the announcement date. Secondary market says, oh, there's going to be a lot of shares sold coming up soon. So the price starts to drop because everybody knows that there's going to be a point in time at which these shares are going to be cheap because there's going to be flooded in the market and there's frictions that prevent the shares from being redistributed very rapidly. Then the shares do get redistributed over time. So this is in days, not milliseconds.
Thank you.
By the way, these lumps here are not, that is, this fact that this goes up and then down, when I first saw these data, I thought, well, it's just something weird. You can solve a model in which that's exactly what happens, but that's too long for today. The intuition is that if let's say, let's take this rising price here. Let's take you, Andrea. You're going to sell here at this point here. And why are you? How does this go again? You need the price to go up and then down. It has to do with the fact that you will not re-enter the market until a random time at which you're going to reappear in the market. I'm trying to remember the exact intuition. Anyway, you don't trade at every millisecond. You're only available to trade every few days. And so...
Because I have the risk that I switch types? Or?
No, it's, the model in which you can actually create this rising then falling price has inattention effects where some people trade at random times and they come back into the market a long time later, like 10 days later. I'll try to remember the exact intuition for why the price goes up and down. And it goes up and then down on this side as well. It goes up and it comes down a little bit. And there's actually an infinite number of ripples. Here's the same effect, much smaller in the US Treasury market. So this is in basis points of yield. So remember, yield is inverse to price. So when the yield goes up, the price is going down. This is the offering date on which the US Treasury Department issues US Treasuries. This are the 2-year Treasuries, the 5 years, and the 10 years. On the horizontal axis is number of days from the issue day. And this is the yield going up, meaning the price is going down into the issue. And then the yield's going down, meaning the price is coming back up out of the issue for both the most recent Treasury and for the off the runs. So this is a very systematic effect, and it's associated with exactly the same story. If the price is going down into the offering, whoops, it's the same as this story right here. Price is going down into the offering, and it's associated with search frictions in the Treasury market. Now, you might say Treasuries, those are very liquid. They are, and that's why the search frictions are only on the order of 2 basis points of yield. It's a very, very efficient market. And they're unloading a large supply of Treasuries. So anyone that's going to buy Treasuries just before the auction says, oh, I'm only going to pay a low price because there's going to be a big supply available in a very short time. And once that big supply becomes available, there's going to be a ton of Treasuries that people will be trying to get rid of. I could get them at a cheaper price later on. I'll take them at a relatively low price right now. And that price goes lower and lower, yield going up, and so on. And then coming out of the auction, whoever owns the Treasuries that got them wants to get rid of them, and they're able to get rid of them at a higher and higher price as time goes on.
Well,
What are the dotted lines going on in the background? Just so
Those are confidence intervals on these. So they're barely significant, but when you take a joint confidence test, you do get this tent shape.
You still get this, rise in bond price before it falls, or
The
drop in yield before it rises.
Yeah, the yield goes up and then down, meaning the price goes down and then up.
Yeah.
Just like in the SEOs, the secondary offerings. And this is true across a wide range of supply shocks. So for example, when a stock is deleted from the S&P 500, there's a massive, I should have put that one in, a massive price drop on the deletion date because everyone that was indexing to the S&P 500 has to sell that stock on that day. And so there's a massive supply shock. The price drops from about mid-80s to 2000. The average price drop was over 10%. 10%, not 10% per year. 10% price drop on the date of deletion. And it took a long time to recover, about 2 weeks.
In terms of your model, your theoretical model, this is just an exogenous shift in the supply.
Yes. So I'm going to give the numerical path for the model in just a moment.
Because there was no role for something like this in your model as you have presented it so far.
Well, there isn't. So I'm going to give one of those right now. So here's the model version of the same thing. I'm going to add one feature to the model, which is a supply shock. So here, I'm going to solve the model with low and high lambdas. But let's take the solid blue line. Let's do it in price space up here. So this is the price of the asset, $9 almost. Coming along here, everything is at steady state as in my model. This model with constant parameters, steady state, with one exception. Everyone in the market has been told at a random time, we're going to randomly redistribute the assets. And people are going to say, whoa, not good. The way they're going to do that is they're going to make a random mutation of types from high to low and back, all at one time, not independently across investors, at one time. That one time is a Poisson arrival time with some intensity, which I've forgotten, but it doesn't really matter because it's only going to arrive once and that's the one we're interested in. When that random supply shock occurs, a lot of the wrong people are owning the asset. Markets had achieved the most efficient allocation they could beforehand, subject to the search frictions. Now things are really bad. People that own the asset, well, there's a lot more people that own the asset that shouldn't own it. And the price drops to, this is the random time at which this supply shock hits, it drops 15 basis points. And then, over time, it recovers.
The value function calculations, people are anticipating this.
They're anticipating, that's right. But what's different from the SEO...
The question becomes much more complicated, no?
Yeah, it's not that much more. This is really more complicated because in this one, it's not only anticipated the shock could occur, they know the date on which it will occur. Whereas in the one that we were able to solve, which is this one, they know the shock could occur, so they're rationally taking account of it, but they don't know the exact date. They just know that it's arriving at a Poisson arrival time. So this is the price shock, the big blue line, when lambda is low. When lambda is high, it's not so much, right? That is, when people meet each other more frequently, the prices at which Andrea and Chris negotiate is not as severely depressed by the misallocation of the asset because, after all, search intensities aren't so bad. And if you have very high, the dashed line at the top is infinite lambda, the market is never affected by the random shock. Because as soon as they're misallocated, if lambda is infinite, it's just like an exchange in which everyone can reallocate immediately. So there's no price shock.
So
Yes, Sanjeev.
trying to understand the thing a little more clearly. So is it the case that the fraction of the population which values the thing at high, that remains constant? It's just
Yes. It's just been reallocated at random. So instead of...
Is that the nature of the supply shock you were taught? I thought the nature would be that somehow
We didn't solve the one in the reality that we looked at before. There was an additional amount of the asset available in the market.
You also rather
We didn't do that one. That wouldn't be that hard to do, actually. I never thought about that. Yeah, Eric?
Is the offering always on just one day?
Yes.
And if so, why don't they spread it over several days?
Good question. I don't know. I mean, why wouldn't, I mean, to some extent indirectly they do, because the underwriter is going to give, in practice, almost a guarantee in price to the issuer. So Fernando Skateboard Company is going to get this price for all the shares that he issues, and then the underwriter is going to take a number of days to lay off the asset later on. He's not going to sell out necessarily on the first day. Most offerings actually go out on the first day. In other words, most of the time the underwriter says, Fernando, look, how about if you issue at a very low price and then we can get rid of it right away? And Fernando says, oh, that's an awfully low price. How about a higher price? And then the underwriter says, well, then we might not be able to sell out immediately and we would have to absorb the risk. And Fernando is supposed to say, okay, absorb the risk. But the dealers don't want to do that. Underwriters almost never lose money, and they also take a big fee. They take a big percentage fee, and they get what's called a green shoe, which means a lot of options to buy the asset later on at the high price. They make a lot of money, in other words. Any discussion about this? I'm just going to say a few words about what we do in the network case, that is, where we're not doing random search in a continuum population, how those models can be solved. I'm not going to have time to fully solve them. Yeah? Michaelis.
In the previous session, but in the new regulatory framework, we switching from bilateral trading to electronic trading.
Yeah, some degree of multilateral trading, not fully electronic.
In your model, it means that regulators, what they're trying to do actually, try to increase lambda. Right?
Effectively. I mean, if you had only one parameter to try to capture the effect, it would be to increase lambda, that's right.
So that the market can deal with these shocks in the supply.
Yeah, that's right. So we would expect, with higher lambda, we would have less severe price shocks, and Fernando's company would get a better price when he issues shares for a skateboarding factory. Any other discussions of this? Okay, so briefly on the network model, I'll do it right over here. In the network model, we keep the bargaining from Rubinstein, but we ditch the random search. That's how it's going, at least so far in the literature. So we have some network, maybe like that, finite number of players. These players can set the prices and terms of their contracts with each other by negotiation. Okay, so here's Andrea, here's Chris. Chris is with a kappa, I guess, in Greek. And when they meet, they each know that they have other counterparties potentially. So it's common knowledge what the network is. And they set two terms. One is what actions they contract to take. So it could be, I will sign a 5-year interest rate swap, 100 billion notional, with the following termination provisions. And these actions have to be consistent with each other. So there's some consistency relationships between the actions that they commit to do. And they agree on prices. I guess we'll call it P alpha beta. Prices at which they agree to take those actions, each knowing that there's another contracting problem on each link in the network. Okay? So now we have a Rubinstein bargaining protocol that sets the terms of the contract and the pricing, with the understanding that a similar Rubinstein bargaining problem is going along on every link in the network. And just
Beta, I mean, if you have, you know, if the external option comes with probability eta, then you bargain with someone else that is neighbors of yours in the network, or what happens?
okay, so well, maybe I should have prepared a whole set of slides for this.
Just
what-
to get an idea,
So-
rough idea of what.
Okay, so roughly what happens is, if these guys break down, they get an exogenous outside action, which is allowed to depend on the actions that they take with others. But they will not trade if they break down with each other. They can still trade with the other guys. So if Chris and Andrea break down, there won't be a trade there on that link. The actions that they take will be restricted. The actions that they take with others will be restricted by the breakdown. So there's certain things they can no longer do. Okay? They're still able to bargain, you know, across the other links if they wish to.
But there are certain things they cannot do with their other partners.
Well, there's no...
The breakdown.
Yeah, so if there's a breakdown, then there's a limited set of things that they can do with their other partners. That's right. And so I'll give you the short answer to... The short answer to this is that if you have... So far we've solved it for 4 in a row, up to 4 in a row network, and we believe it's true for trees. This is joint work with Chaojun Wang, who was here 2 weeks ago at the first week conference. What we've shown is that for up to 4 in a row, or for trees, you get fully efficient contract terms. The S's are fully efficient. That is, they're the best choices of S possible, subject to the network structure. We do not know if it works for networks with circles. So with cycles, we're not sure. So that's a very brief introduction to what happens on networks. There's another paper on network OTC markets by an economist at MIT named Hao-Xiang Zhu. And he has a paper in the Review of Financial Studies about 2 years ago. But he doesn't use Rubinstein bargaining protocol. He does a different kind of bargaining. In our model, there's no search. In Hao-Xiang's model, anybody can go to anybody and search for a good price. So it's a different setting, but it's again a finite number. The nice thing about Hao-Xiang's paper is that, as I mentioned earlier, if I don't like Chris's price and I go to Michael, and I don't like his price and I go back to Chris, I'm at a disadvantage, and Hao-Xiang is able to show how much of a disadvantage that is in terms of the price we negotiate.
I mean, consider that you can apply these sort of large number techniques, large population techniques, to a network setup as mean field approximations of a large random network, for example. It seems like this would be a methodology that would be pretty
tempting to try.
Pretty suited to studying this sort of problem in a large network modeled as a random network.
Yeah, you would have to have a lot of symmetry in the network, otherwise you'd never solve it.
Stochastic independence, no?
Something very strong, something very
Stochastic
strong.
independence, yes.
Yeah, because otherwise the dimension of the system is too big. Yeah, I haven't even thought about trying to solve that. These are the two extremes. So this model with a continuum of very similar investors, and this model with a small, finite set with direct negotiation, no search. They're essentially opposite extremes of the theory. This one is just coming out. If anybody wants a copy of the paper, just send me an email. Any questions before we break?
Well, what do you think the difficulty is once you've got a cycle in the network? I mean, it seems to me that, you know, just loosely, intuitively, that, I mean, it's breakdown on that. You know, it should be able to go around the cycle as you were alluding to in earlier.
Well, okay, so let me be a little bit.
An equilibrium price.
Let me be a little bit more clear. There's no doubt that there will be some equilibrium. What the theorem said is that we're going to get the unique, in fact, we have a result that says, subject to what's called trembling hand perfection, which means if you miss hit by epsilon, it won't matter. You'll get a stable equilibrium. There's another Nobel Prize, Reinhard Zelten, has this notion of trembling hand perfection. I don't know if you know about it, for Nash games. Subject to trembling hand perfection, there's a unique outcome with trees, like this one, which is efficient, which is the unique efficient choice of actions by all the nodes in the network. So S1, S2, S3, and S4 will be chosen to optimize social welfare. And if there was a cycle, no doubt there's going to be some equilibria. I don't know if there are multiple equilibria that are trembling hand perfect. I don't know what's going to happen. I don't, just don't know.
Would you check it out numerically?
No. Haven't tried. Just it's brand new work. But
It's not going to give you a theorem, but it might at least tell you whether the result
it could, yeah. This is hot off the press, so the first, you know, it's a monster project already, but we'll try. We'll try. I honestly don't know what's going to happen with cycles, but my suspicion is that when you have, you know, everybody thinking about what the next guy is thinking, and it's coming back to you around the cycle, you might not get uniqueness. Yeah, Ronald?
I think you wouldn't. I mean, yeah, that's probably.
In these models, can you write down a simple dynamic, like a Markov chain dynamics, where the players update their choices sequentially that leads to the equilibrium as an asymptotic outcome?
Well, we have the way our equilibrium is achieved is via this bargaining protocol. So every pair of nodes is conducting a dynamic bargaining protocol of this exact type. One round for the terms of the contract, another round for the prices.
But is this being done conditional on the other nodes?
Yes, that's the trick. You don't get efficiency if they don't do it, if some of the nodes at least, more central nodes, are not doing it conditional on the contracts being signed on the other side.
What's the information that each node has at its disposal?
You're asking just the right questions. So each node knows only the actions of its nearest neighbors. And by the way, I should have mentioned, strong assumption, the utility of any node depends only on its own actions and those of its nearest neighbors. If you have externalities where this guy's utility is affected by this guy's action, you'll get an equilibrium, but it won't be the efficient one. I mean, you may get inefficient equilibria, even after the trembling hand perfection refinement. So there's strong assumptions that are needed to get this efficiency result. And in general, you should expect spillover effects that cause network-based markets to achieve inefficient solutions.
Like what?
Fire sales would be an easy example.
So in this case, not just fire sales, I mean, if you have to impose a rule, like a constraint that is based on your view of the whole system, like as a regulator.
Yeah, I mean, central clearing could be a way of overcoming some of the externalities that would lead to inefficient outcomes in this setting. So there's plenty of scope for regulation. So even though the market participants on their own, like in this kind of a setting, can achieve efficient outcomes, if there are distant externalities, like if I sell a lot of an asset, then the price will get depressed for others down the rest of the market, and that could send the market off into a systemic risk event. You know, then you won't get efficient outcomes.
So can you sum up this picture by saying that if you have an OTC market in which there's a search mechanism, like a random search mechanism, enough participants, and each participant is very small, so they cannot manipulate, dominate the pricing mechanism, then through this random search, they converge to some efficiency.
If by converge you mean as the search intensity becomes infinite, yes. In fact, there are theorems about that by Douglas Gale, for example, has a nice result about that. But if the search intensity is not going to infinity, then no, they won't achieve full efficiency.
Slowly.
Even slowly. Because, again, you're getting mutation of types along the way, and then they want to do something else, and it takes time to get there because of search frictions. And if you allow endogenous choice of search intensities, whether you get efficiency or not depends on this complementarity effect that somebody was asking about.
But more.
Maybe you.
Yeah, but if you compare to the real situation, the bigger obstacle is probably the fact that some participants have a large size, so they can create distortions to the model.
Well, I think also of the Lemmings model, you don't need large size to create inefficiencies. If everybody's going one way because nobody is internalizing the benefit of going the other way. An example, well, I could give you lots of examples, selling. If everybody is really small and everybody thinks to himself, I'd better sell because everybody else is going to sell and I want to get there first, you can get a fire sale effect for no need. But if there's one very large market participant that says, I'm going to buy against this sell because I can make a lot of money and stop the fire sale, then you'll get efficiency. So, the fact that there's one very large market participant could be either good or bad.
J.P. Morgan in 1907.
Exactly.
The efficiency that you were mentioning, you said the outcome will not be efficient because of the friction. But I think the reasonable test of efficiency would be one that allows for the friction.
Yeah, so second best,
Second best, okay. That's the meaningful.
Yeah, and here you have.
So in that context,
Absolutely.
it is efficient. No?
So here the inefficiency is the network structure. The network topology is the source of inefficiency.
Yeah.
But subject to that, we get full efficiency provided, again, no cycles and no distant utility effects. Very strong assumptions. Yeah, Matt?
Going back to your continuum model, you said it's solved the case with endogenous search intensity.
Yes, with complementarity.
Have you looked at also in that model having multiple goods? And so you have more than one good being sold. I wonder whether you might get endogenous intermediation.
There is some work in that direction. Pierre-Olivier Vey, who's an economist at UCLA, has some work in that direction. You might also, if you think about Kiyotaki and Wright, you might think that there's also multiple equilibria in which good becomes money-like. So, liquidity goes where liquidity is. That kind of multiplicity is to be expected. And in a market with all of us are potential dealers, and one of us happens to raise the flag first saying, I'm the actual dealer, everyone will go to that person. And it's kind of arbitrary who raised the flag first. Well, we're now completely out of time, but I'm happy to stay and talk as long as you guys want. But I'll call an official end, and anybody who wants to stay unofficially, we can chat afterwards. Thank you.